Okay, great. Welcome, everybody. Heather Chubb, aging care attorney with Chubb Law Firm PC. And today, my guest is Scott Roseveare with Live Well Financial, and he is going to enlighten us about reverse mortgages. For me, I know that's a topic that I needed a lot of education about. They've gotten a bad rap in the past, but they can be a really powerful tool in the right situation. So, Scott, welcome today. Help make us smart.
All right, Heather. Well, thanks for the introduction, and thank you for attending first thing in the morning, learn about reverse mortgages. So I appreciate that. So what would you like to know? Like, what would be the first thing you want to know?
Yeah, well, let's start super simple. How does a reverse mortgage work?
Okay. Yeah, let's start with the basics. So I think the first thing to do is to talk about who qualifies, like who are these actually available to. So the first thing is you have to be at least 62 for the government product. Only one spouse, if there's a husband and wife, has to be 62. And the way it works is they only look at the value of your home and your age to determine how much you can qualify for. So they're one of the easiest loans to qualify for. It is a government loan, so there's a lot of paperwork, but they're really easy to qualify for. There's really almost no income requirements. You could even have really bad credit. They just require a little bit more equity. And the amount you can take out is based on your age. For example, if you're 62, you can usually take out about a third of your home's value. So if your house is worth, say, $900,000, you can get a reverse for about $300,000. If you're in your 90s, and we have a lot of clients more than ever in the last couple of years, seems like people living forever these days, you can take out about 2/3 of your home. And these are all lines of credit. And that's something that people don't really realize. This is not, here's a giant check for $400,000. Most seniors need more cash flow. They don't need lots of money up front typically. So it's really just a line of credit, and you take out money as needed. And basically it's an option to pay it or not pay. So some people actually pay into the reverse mortgage like a normal loan, but you don't have to. So if you don't pay, their interest is added to your loan and deferred paid to the lender until the house is sold. So that's kind of the basics of how they work.
Okay, great. So, help us understand. Reverse mortgages, they kind of have a negative reputation over the years. There were some really bad ones. So, how have things changed, and why is it a better product now? Because it is a financial product, right?
No, it is, and you're right. When I go do educationals, I think you maybe have seen one. The first thing I do is ask how many people in the room have heard anything negative about a reverse mortgage. Every hand goes up, sometimes two hands, and for good reason. I mean, before 2017, it was kind of a last resort product. People were running out of equity within 5 years, and the adult kids were just seeing their inheritance vanish, writing blogs and posting articles, and seniors were selling their homes with no equity, giving their keys back for closing. And the reason was there's really no regulation on a number of issues. One is equity was not protected because they allowed, say, Wells Fargo was charging $50,000 for just their fee. Interest rates were higher. And the biggest part was they allowed seniors to take out a very large portion of their home. So they could take out 3/4 of their home immediately. That did not last very long. So what happened was the government, since this is a government insured loan, so if the house has a negative balance, the heirs don't have to pay it. The government does, but they were tired of paying all these underwater properties off. So they're like, wait a minute. So they capped how much we can charge to like $6,000. They lowered rates, but they lowered how much people can take out, which has really made a huge difference. It really protected. So less people qualify, but the ones who do are going to usually see their equity increase over time, which is not what people think about with reverse. So that's the major difference. So 90% of seniors pass with positive equity now. It's pretty cool to see.
Okay, that's great. Those sound like really good changes to protect both the government's investment and the senior as well.
100%.
So great. So how how can seniors use reverse mortgages? How can that help? What's a good situation for
Yeah, I mean,
looking at a reverse?
so, especially in this day and age with people living so long and, we're seeing more cognitive impairment diseases, Alzheimer's, dementia, Parkinson's, which are really expensive. I mean, the average cost of dementia right now in the Sacramento area between in-home care, daycare, memory care, assisted living, skilled nursing is about $400,000. So people don't usually have the portfolio to absorb that kind of a hit. When you look at 42% of seniors over 80 are going to get one of these dementia kind of diseases like Alzheimer's. There's almost a 50-50 chance you're going to be facing this huge bill. So it's about cash flow, whether it's trying to pay for in-home care. How do you come up with $5,000 a month? So this product, this line of credit allows seniors to convert a small portion of their home equity into tax-free monthly cash flow because the money in your house is kind of trapped. Unless you sell it or get a big mortgage with the payment, you can't really get it. This allows them to access it in a very responsible way.
Okay. All right. So how about giving us a scenario where you had a client that really benefited from a reverse mortgage? Help us see this in action.
Boy, there's lots of them.
Yeah, I'm sure there are.
I mean, obviously, I think the one that hits most home is my family. My father-in-law suffered a stroke, and he was in a wheelchair. The doctor said he could probably never walk again, and he lives down in Antelope. A lot of equity, like most seniors have a decent amount of equity if they've been in their home for 15, 20, 30 years. My mom's been there for 57 years, crazy. But my father, so they were stuck. They couldn't really afford to pay for the rehab that they needed. They have IHSS, which is a Medi-Cal program.
Mhm.
It wasn't enough hours, kind of a revolving door of caretakers. So we got them a HECM line of credit that allowed them to do an intense year-long therapy. And after a year, it was amazing to see. I mean, my mother-in-law was just astounded that now he is walking and he can walk and only uses a cane sometimes. So these are the kind of stories that I just love this business and being able to make that kind of a difference. So he's able to walk and pay for all the safety features in his home. Got a new roof. So that's just a pretty typical situation. Half of our clients are more in the health, paying for health or medical expenses,
Mhm.
and the other half are more. I just need an extra $1,000 a month to live better. Things are so expensive these days, right? I have clients that are just wanting to vacation more or remodel their kitchen. So there's a lot of use cases for it. But again, it all comes down to how do we increase cash flow to a group of people who are generally on fixed income. It's hard to spend less. So we help them to get more.
Yeah. What a great example. I hadn't really thought of using it in that way so that he actually did come out better on the other end.
Yeah,
And
pretty
by
cool.
better, I mean he was able to enjoy life more. He wasn't totally on the downside. But
More
if
dependent.
somebody wanted to learn more about how a reverse mortgage could work for their particular situation, how would they do that? How can they reach you?
Yep, no problem. So the first step is to do an equity analysis. And that's a fancy word for saying, all right, how much equity do you have? And is that enough to qualify for a reverse mortgage? So for instance, let's say a client came to me and said, hey, listen, I'm short of cash flow. I could really use an extra $2,000 a month to help out with bills, healthcare, whatever it is. It's the first question to ask, okay, how much is your home worth or what's your address? And I'll look it up for them. I'll look at comps because the value is a very important facet of it. And the next thing is I'll ask them, okay, right off the bat, what's your date of birth, which they love to hear. I'm not asking about your weight or your favorite color, but I have to know what your birth date is because they take the age of the younger spouse. So if one's 75, one is 70, they base the amount you can qualify for on the younger spouse, in this case, 70. Then I ask, what is your mortgage payment and what is your mortgage balance? So with just those 3 or 4 pieces of information, we can generate basically some options for them in about 15 minutes. So I can say, okay, based on these situations, you can qualify for, say, a line of credit for 300 grand. If you have a mortgage, we'd pay that off. That payment goes away for life. If they don't have a mortgage payment, then they actually have access to a line whenever they want to.
Mhm.
Then from there, I'll show them, what is your future equity forecasted to be in the next 10, 20, 30 years. And once them, and as you can imagine, I talk to a lot of adult children and CFPs, which is ironic. CFPs is where we get most of our referrals because it's becoming a really important part of a retirement strategy. But they'll almost always see their forecasted equity, like I said, increase over time because your house is appreciating faster than interest is accruing on the loan, which is a great thing. So the kids get their inheritance, parents are taken care of, everyone wins.
Great. I have a question that I think is a little bit off script, but appropriate. So we have seen home prices increasing. What if you had the reverse mortgage and prices dropped again like they did? Well, probably let's not make it as dramatic as 2008, but let's say we reverse that trend. What would happen with that reverse mortgage when the owner passes away?
Got it. Okay. So the first thing is if houses drop in value, yeah, 2008 was an extreme case.
Mhm.
All mortgages, forwards and reverses, a lot of them are short sailing. What's unique about reverse mortgages is you're protected on any downturn in the housing market. So, for instance, if a house is worth less than what you owe, if you're still alive and living in your home, they can't call it due. As long as you live there, you're good to go. But if they're forced to sell or if they pass away and the heirs take over, what's nice is any negative equity is picked up by the government. So they pay the negative balance so that heirs don't have to. They basically just give the house back to the bank at that point. They wouldn't have to owe anything like a traditional 30-year fixed, or if it was underwater, they'd most likely have to pay it with the estate.
Great feature. All right. Well, we have actually come to the end of our time. It always goes so quickly. Scott, thank you so much for joining me this morning. I know it's really early in the morning. And for our viewers, if you are interested in exploring reverse mortgages, please give Scott a call and see if that's something that would work for you.
Great. Thank you so much, Heather. Appreciate it.
All right.